Jean-Maire, are you still as enthusiastic about the prospects for gold?
I'm looking at it more as an insurance policy, just in case bad things happen. After all, the past 3 years have demonstrated that, contrary to the 80s and the 90s, every now and then bad things happen.
Despite the big move in gold stocks, the move in the metal itself was not that immense. Why were the move in the stocks greater than the move in the metal?
Because the gold mining stocks provide both operating and sometimes financial leverage. So when the price of gold goes up or down 10%, usually the gold mining stocks go up or down 30%.
I'd said you'd sometimes err on the gloomy side. How gloomy are you right now?
We're not gloomy, really. I mean, if I take the S&P 500, it's at 900.
You're just French.
Yes, I give it a Gallic shrug, I suppose. If I take the S&P 500 at 900, doesn't strike me as undervalued. At the same time, the American market is a big market. It's a broad market. And as equity markets come down, our attitude is, hey, maybe there is a stock which we looked at 35. We thought we liked the business. We thought we understood it. And 6 months later, the stock is at 25, then we buy it. So we tend to buy in declining markets, and we tend to sell in rising markets.
What are you doing now more of?
We're doing more buying. We have very little cash. In the global fund currently, we have only 6% in cash. In the overseas fund, about 7%, although we also own some fixed income securities. Corporate bonds, in particular, I find extremely attractive.
As between the U.S. and the rest of the world, is your ratio of investment higher than usual, lower than usual, about the same?
It's lower than it has been on average over the past 25 years or so.
You think the U.S. market is more highly valued than the foreign markets?
It's more a matter that from the bottom up, we find more easily investment opportunities in Europe and in Asia.
Looking from the bottom up, looking as you do for undervalued securities, and I know you always are concerned with private market value and what a knowledgeable buyer would pay. What are some of your favorites now?
In the U.S., over the past 6 months, we've established fairly large holdings in both Liberty Media.
I've heard that one before.
That's right, and Tyco International as well.
I heard that one before too, but that's the one that always startles people when a value investor says he likes it. Tell us why.
Because we never owned it when it was popular, but we could see that Kozlowski had over the years acquired the kind of businesses which we ourselves tend to like, assuming the price of the security is right. We just never could understand how he could pretend to grow 20% a year, because those are mature cyclical businesses. And then the stock went down to 20, and we bought it all the way from 20 to 10, and it's at 15 now, so we don't yet have much to show for it.
How long do you typically hold stocks?
On average, 4 or 5 years, so we tend to be on the patient side.
Now, why your affection for Liberty Media? Why do you like it?
Because we own so-called holding company stocks in Europe. Liberty Media is one of the few in the U.S., and we get what the value investor loves, which is sometimes a double discount, whereby we buy a package of depressed media assets, and we buy them at a discount to what they're worth today. So we figure Liberty Media, as it is today, is worth at least 15, and the stock is 9.
Do you have another favorite you want to mention?
We own Vivendi, which is also a controversial stock in Europe, for about the same reasons. We think the value of the media assets is about 25, the stock is 12.
Do you ever buy anything that's popular?
No, we seldom do. I mean, together with value investors, I mean, we get the opportunity to buy stocks cheaply because usually the short-term outlook for what we buy stinks.
You do not right now regard the overall U.S. market as especially cheap. Is that correct?
That's true.
Do you think it's too expensive?
Yes, it is. And one thing that puzzles me is that you have the so-called operating earnings, which corporate managements and Wall Street, which sometimes, forgive me, Mary, sometimes Wall Street is a vast promotion machine.
See, I didn't know that.
Why? They look at operating earnings, maybe $45 per share this year, And then Standard & Poor's, and there are no bizarre people at Standard & Poor's, they're sort of establishment types, and they say, hey, maybe there are core earnings, which, the problem with operating earnings is that you get pension income in there, you don't expense the cost of stock options, you take in, as extraordinary charges which in fact are recurrent. And Standard & Poor's comes up with core earnings of only $35. So 900 to 35, S&P 500 is not particularly cheap.
You like them when they've taken the hot air out.
That's right, and some have.
Let's turn you over to a panel that never is involved in anything like what you just mentioned, starting with Mary Farrell.
Jean-Maire, you referred earlier to investing in Asia, which has had a remarkable recovery since the disastrous financial condition in 1998, with the notable exception of Japan. Do you think there's any hope for Japan coming back and being a good place for investment?
I hope so, because we own a lot there.
Oh.
Because from the bottom up, after a 12-year bear market, there is a good number of Japanese securities that are attractively priced. But we try to exercise some self-restraint, because even though Europe has problems, the US has problems, Japan seems to have sort of intractable problems and an immobile, almost paralyzed society and government. Mm-hmm. So we worry about that, but from the bottom up, Japanese stocks are attractive.
Jean-Maire, one stock that might fit your profile, or could fit your profile, is America Online. Do you have any thoughts on that?
Well, we own it indirectly and very partially through Liberty Media. But otherwise, I don't mind only owning it indirectly and partially, but I don't think I would own it directly.
Jean-Marie, there's been hardly a groundswell, but a little bit of reviving interest in stocks that pay dividends in this country. And next year, we're hopeful that there'll be remedial legislation. How about dividend payers in Asia and especially Europe? Are there any attractive ones there?
Yes, there are quite a few in Europe. The average yield in Europe is 3% as opposed to 2% here. And particularly in the UK, you find the stocks of industrial companies that are well established and successful, where the yield can be 5 or 6%. You have Vienna Airport, since quite a few of the European airports have been privatized, where the yield is 5.75%. So yes, indeed, you do find stocks with yields of 4, 5, and 6%, while the 10-year government bond in Germany yields only 4.5%.
Jean-Marie, what would you be selling now? What are you selling now?
We are selling the stocks in our portfolio which have reached what we believe is their intrinsic value. But as I said, we were...
Do any of them have names?
Well, I'm not sure I want to name names. Although, for instance, we had bought Tiffany at 20. We were uncomfortable buying it at 20 because even at 20 it was a little bit expensive to our taste. Has moved to 26, 27. We have sold a little of that.
When you buy a stock, do you determine what you think its fair value is?
No, we do. We come up with so-called intrinsic value. I think one of the great contributions of Ben Graham was the idea that stocks could be more than just pieces of paper to be traded in and out of based on market psychology.
It must be satisfying to someone like yourself who suffered through the go-go years and had people say you were out of touch to be on top of the world now. Do you think this will last, or do you think it's all cyclical?
I think it's all cyclical. I mean, 3 years ago, people thought I was half senile. Not quite, not yet.
Do you have an antipathy to growth? I mean, when you look at a company, is growth important?
It is, but I just don't want to pay for it.
Would you buy a company that wasn't growing at all?
Yes, I think the theoretical case can be made for owning the stock at a certain price of a company where the earnings would be stagnant forever.
And you think that the basic thing is to make that value check. Do you do that through computers mainly or through other kinds of study?
Oh no, because we tend to recast financial statements. We never take reported numbers at face value, so we hardly do screens.
So you're basically skeptical about most of what you receive?
Yes, indeed.
And how do you make that independent judgment?
Well, we try to understand a business. We try to decide what the strengths and weaknesses are, and
And there we do have to stop, but with thanks to Jean-Maire Eveillard, one of the great value investors of our time, and to our panelists. Next week, my guest will be a highly influential investment strategist who was correctly pessimistic about the market's prospects for a long time, now has some surprisingly upbeat views on where the big money is going to be made. He's Barton Biggs of Morgan Stanley. You won't want to miss him. Meanwhile, this has been Louis Rukeyser's Wall Street. Good night.
Louis Rukeyser's Wall Street is produced by CNBC in association with Rukeyser Television. The program is being distributed to public television stations by WLIW New York and has been brought to you by Occidental Petroleum. At Occidental Petroleum, we employ advanced technologies for oil and gas recovery while helping preserve the environment of the world we all share. And by A.G. Edwards, providing a full range of personalized financial, retirement, and estate planning services. A.G. Edwards, trusted advice, exceptional service. And by Oppenheimer Funds. What makes a true champion? The ability to prepare with discipline, to perform with passion, to compete with determination, again and again. Oppenheimer Funds, the right way to invest. Printed transcripts of this program are available for a $10 fee. Call Burrell's Transcripts at 1-800-777-TEXT. Louis Rukeyser's Wall Street is produced by CNBC in association with Rukeyser Television. They are solely responsible for its content.